All right, welcome in. I see people starting to connect. We have another 2 or 3 minutes before we get started, but thanks for joining. We have a great presentation for you today. Hope everybody's having a good start to their days. So just a few more moments. So I appreciate everybody's patience. We're going to get started around 12 or 12:01. Give people some time to connect to the presentation. All right, it's about 12 right now. Again, as I said, for those who are still connecting, we're going to give another minute or so before we kick things off. So I appreciate your patience. All right, that should be enough time. We'll go ahead and kick things off now. All right. Hello, everyone. My name is William Mucker. I am a client executive with Camaplan and would like to thank you all for joining us for today's webinar, Pro Sports Investing and Ownership, No Longer a Billionaires Club with Tom Mitchell and Jean-Paul Recht. As a quick note, please be aware that we'll be answering questions at the end of the presentation. However, feel free to use the chat and/or Q&A function on your screen to pose your questions whenever they cross your mind. They will be saved and addressed once the presentation portion ends and the Q&A portion begins. Before we get started, we do have a brief disclosure to go through. Everything presented in today's webinar is strictly for educational purposes. Camaplan is a neutral third-party administrator of IRAs. We are not attorneys, CPAs, or financial advisors. If it comes to a time where you need advice in any one of those fields, we highly recommend you consult with your team of professionals. We're more than happy to be a part of the dialogue with your team of professionals to make sure the investment process is quick and seamless. We do not sell any investments at Camaplan, nor do we endorse any products. We will never call you about the next best investment opportunity. We believe that you should always do your own due diligence before investing your money, whether it be your retirement funds or otherwise. Once you have found the investment that is right for you, we will help you open your account, fund that account, and facilitate the transaction into that investment. Here is my contact information. If you or anyone that you know who you believe can benefit from the information have any questions about what is discussed in the presentation today and how it applies to your self-directed IRA, please do not hesitate to contact me. I would be more than happy to help. And without further ado, I'll pass the controls over to you guys.
Thanks, Will. Appreciate it. Hey, everyone. I'm here with JP, and we're here to cover some of what's going on right now in sports entertainment and really talk about what's driving it. Because it's an exciting time in sports entertainment, but there's definitely some indicators and some factors driving the race, as we call it, in both Tier 1, Tier 2, Tier 3, and Tier 4 sports right now. So what I'm going to do is I'm going to bring up a presentation to go through that real quick. Okay. So in sports entertainment, there's really two main revenue streams that everybody's racing for. And that would be the media rights deals and expansion fees. And what's happened really over the last 4 or 5 years, but it extends back probably a good 10 or 15 years, is the exponential growth of valuations. And now with the media rights deals and the race in the media rights deals, we're seeing valuations skyrocket again. And there's some things that have really come out of COVID that's sort of driving the media rights. Number one, streaming has become a very big factor in sports, and it's taking over. The lower cost for streaming and the ability and the demand for more content from consumers is merging as a perfect storm. And you're seeing battles across the landscape for any kind of content, as long as there's demand by the consumer base for the product. What has transpired over the past year, you can take a look at what's going on in the WNBA. You can take a look at what's going on in the NFL, and even outside of the top tier sports, you can look at what's going on in WWE and just see it's no longer high-end millions. You're starting to hear deals in the billions of dollars every year. What I do is I've broken it down so that we can kind of look at things from tier structure. And the tier structure is really, it's revenue driven. So now you're looking at what most people know is the big four, which would be the NFL, the NBA, MLB, and NHL. And you can see the MLS, in my opinion, has now moved into a tier one sport here in the United States. Where they were 15 years ago and where they are now is pretty amazing. But when you start to look at the tiers and you start to look at the deals and the per year deal, there's a lot of contributing factors here, but there's definitely some patterns. Number one, it's demand driven, obviously. When you start looking at the attendance numbers and where are they going? Are they going up? Are they going down? And how that's affecting these media deals. The player salaries correlate with that. And every one of these leagues is really different and unique in the way that the players get their salaries. In some of these lower, what I call lower tiers, NWSL, WNBA, you're starting to see movement, and you're starting to see those salaries escalate as though they're in the NFL, NBA, and MLB. You're starting to see them eclipse bigger numbers and grow exponentially every year. Another big factor for this is the amount of teams in the leagues and where these markets are located. The expansion of the NWSL and the WNBA is one that everybody's paying attention to right now, because the numbers here are driving a lot higher than what we would have anticipated based on the average attendance and fans per game. So they're projecting that these numbers in these lower tier leagues is where people can make more money as an investor. The NFL, the NBA, the MLB, NHL, and even MLS now really have turned into institutional opportunities only. When you look at these lower tier leagues and the opportunities down here, it's really where what I call the everyday or retail investor can get in and get generational wealth from the opportunity. And one of the big factors which I'm involved with is arena football. In 2008 was a really interesting time. It was a turn for arena football. They spent years and years in building and growing, and they built up to an average attendance of about 12,000 a game. Had TV deals, had 17 teams, but there were some issues internally, probably with the model, that didn't allow them to move forward. At the same time, they had similar expansion fees and similar media rights opportunities as MLS. And you look at what MLS has done over the last 15 years. And now you look at the recent boom coming out of COVID, which has really helped the NWSL and WNBA, and it shows there's a big opportunity probably in arena football. And that's really where I came in and where I started looking at things as someone that had an experience in arena football, experiencing it back in 2008. I know the demand is still there, and the demand is what drives all these media rights deals. So what we did was we started taking a look at the industry and what the issues were in these spaces for the last 15 years. What's causing the lack of ability for growth in one space, where at the same time the MLS is now booming and moving? And I think a lot of it has to do with the franchise model and the way that they've been going about it for the last 15 years. They've stuck to the typical franchise model, which is sell licenses, sell markets. They're selling them to inexperienced buyers. And I think that model is broken, especially for the lower tier leagues, because there's no support system for them. There's no blueprint for these owners to come in and drive teams to success. And in a league like that, you're only as strong as your weakest link. And what happens is they get these owners in, they get sales and infrastructure in that have a lack of sales or marketing experience in these particular leagues. You see a lot less budgets for marketing, a lot less marketing campaigns. And in the end, they go into these markets and nobody knows about it. You could be in a small market of 500,000 and still you walk in and a lot of the consumers in the market are not aware there's a team playing there. A second big piece, I think, where MLS has done a great job of, so the MLS actually has that support structure where they have a central ticket model, where they have a sales team that helps sell tickets, helps promote tickets, helps the marketing teams sell sponsorships. So there's a support structure there. Another big, I think, failure, I would say, over the last 15 years is the lack of focus on the entertainment side and the game presentation side of arena football. Arena football is built around being sports entertainment. It's built around fast-paced, high-energy action, violent action, but it's also built on fan engagement. And when it was done right in 07 and 08, and you saw 12,000 people coming to the games, you saw a lot of pyrotechnics, you had a lot of great music, you had high-scoring action, but you also saw a lot of integration with the sponsors and the partners. They were involved in the content, and involving them in the content to go with great music, to go with pyrotechnics and laser shows, created an overall experience for the fan, which was much more than just an 8-on-8 football game. That, to me, has been lacking for a great part of 15 years. And all these, what I call failures or inabilities, has opened up an immense opportunity, because there is still a high demand. There's a high demand for content, but there's also a high demand. NFL is still king. We're still football. We still have violent collisions, but we can just create much more entertainment and an experience for the fan. And that's the opportunity that I saw that got me excited again about arena football. So I created what I came up with a model that I thought was what was needed to withstand and be sustainable, that will allow scalability, that will still allow us to drive towards those media rights and create great valuations. And I call it a hybrid single entity model. What that is you start as a single entity where you own and operate all the teams. You have a central sales team that helps support ticket sales for all the teams. You have experienced central sponsorship sales, which help push sponsorship revenue to all the teams. So you have one main function as the brand, as the IAL, and that's to support all your teams and help all the teams flourish and not leave anybody out on an island on their own. When you do that, that's the stability and sustainability that creates the demand, that creates credibility, that will allow you to drive these markets up and create the demand for the media rights deals. Another big piece that I've noticed over the past 15 years is that the majority of the buyers don't have any previous experience either in arena football or in the business side of sports entertainment. It's a missing factor. When you're missing that factor, it becomes harder to build a good infrastructure because you're not sure what you're looking for. You're not sure what you're looking for from a person that's going to go out and do a media deal. You're missing a lot of the opportunity to put together packages for your sponsors and your partners that get them integrated into the content. The biggest problem that they have is their ability to focus on three important revenue streams. Arena football has a lot of advantages over a lot of the other sports. Number one, it's intimate. You get access to the players. You get it's football, but it's in tight, closed quarters, so you're on top of the action. When you think about hockey, you think about what goes on in a hockey game. The glass is up, so there's not a lot of communication that can go back and forth between the players and the fans. You take that glass off and you play hockey, and there's a lot of communication that goes on between the players and the fans, and you can hear the players talking to each other. There's important things that are missing that they don't have. The biggest problem that they've had is when they open up their doors, their number one priority is to get a media deal. So many of them chase that media deal from the beginning. They get inked into bad deals. They then can't back it up with ticket sales, which hurts their sponsorships, and it creates a dead environment in an arena, which is not good on TV, and they lose the deals with the TV, with the broadcasting and the media rights deals. There is a specific blueprint for success. It's put butts in the seats, put on a great show, great presentation, get your sponsors, get them integrated into the content, your merchandise will come. So you could build a league successfully your first 2 years and just focus on ticket sales, sponsorships, and merchandise. You build that up across the board, and then your media partners will follow you because you've created the demand. If you're the buzz of the town and you're in 12 markets and you've got good attendance, they're going to come to you. They're going to want to be part of that. It's the wrong model for the last 15 years. And I think that's a big piece of it. But while all this is going on, and once you get those media deals in, and you have different segments of your media deals, the media deals drive your team valuations up. So now you're talking about a second big revenue stream for this model. The hybrid single entity model allows you to build them and sell them. Build them and sell them. And when you're selling them, you're selling up to 75%. So you're retaining 25% and you're selling off 75%. And you put restrictions on those sales to make sure that they adhere to minimum requirements that you built them up to. And the way for us to do all this is focus on entertainment, fan experience, and game presentation. It's such an easy thing to do when you control all of it. You give standard guidelines for them, standard guidelines for in-game presentation, standard guidelines for your fan experience, for your sponsors to be part of the games. You bring it all together. Arena football is fast-paced, high-scoring. So if you go out there and you put a 2.5-hour game and you have great music going on, you have great pyrotechnics, you create sponsorship opportunities and you integrate them into the content so they become cool to your consumer base. And then you have fan interactions and you highlight that, all of this around hard-hitting, fast-paced action for 2.5 hours. Now you have an experience for the fan. And that's where they were in 2007-8. The reason for the collapse in 2007-8 wasn't because of a lack of demand. And it wasn't because they didn't have good presentation. There were other factors that led to that. It was the model that needed to be changed and probably the vision of where they could go to expand. So I think that's still there. I know it's there, and that's what we're building. What I've done is I've assembled a team because what we're building in this is a pretty big lift. So everybody that I've brought into our team, I've either worked with, I know about their past and their successes, or I feel they're very good at marketing. And I've assembled, and a commissioner, it's a lot younger than most. 35, 36-year-old Commissioner Dan is a sports attorney, and he's represented the Giants in the public relations, and he now represents the sports arm of Moorcock and Hammer up in New York. One of the things that I found very impressive about him is his marketing ability. He hosts numerous podcasts. He appears on Fox Sports. He's been on ESPN. Very well versed, but also very passionate. Daryl Harbin and I both worked for the same person in AFL in the past. He's got extensive experience in sponsorships, and we have both of the same vision for arena football and what it can be. And I'm very excited to be working with him. Taylor Hooks, our Director of Entertainment. Boy, she's worked her way up. She worked with me 10 years ago at an arena football team. She handled our dance team, and she's a former Lakers and Clippers cheerleader. and dancer that went on to the front office with both organizations, and worked in game ops and entertainment. And so I think that was a very big jump for her, and I'm excited to be working with her again. We have went out and we got Corrine, who's well known across the NFL landscape. She does a lot of podcasting with former NFL players, but she's also a former Trailblazers dancer and has now really broadened her entertainment side of her resume. And we're bringing her in as director of fan experience, and she'll be working hand in hand with Tariq, who's going to be our director of ticket sales. He's coming to us after working at Learfield Sports as a manager over there, and he worked 13 years in the NBA and NFL in different ticket sales capacities, VIP ticket sales, suite ticket sales, high-end ticket sales. So I'm looking forward to working with everyone here and bringing this puzzle together. And I think, one of the most important things in doing all this is really having someone from the opposite side as part of our team. And that is why I went out and I brought in Steve Eckerson. Steve was the GM of the arena for my team that I ran up in. Good question. I saw a question come in. I'm going to get to it in 1 second. Steve was the arena GM of a team that I owned out in California, and one of the best GMs I've come across. He's well known, well respected in the industry. So he's really good to have on our side to help us navigate some of the arena negotiations that we've had. And I lean on him quite a bit in that. But when you start pulling all this together and you start to see what all this is, these are the missing components that none of the other leagues haven't had in 15 years. They haven't had this experience. They haven't seen all the failures and the successes and be able to bring all this knowledge and data points together to create this great league that we're creating. Real quick, one of the questions I have coming in is, what have you learned from the recent revival and subsequent merging of the XFL, USFL, and now the UFL? Boy, that's a great question. What I would say is they're more focused, I think, on the product, trying to be a step-up league for the NFL, and I think they have a ways to go. We'll see what happens this year. I don't think they reached their goals over the last 2 years with the launch of that league, and I'm interested to see what happens this year. When you look at outside versus inside, I think it gives us a lot more opportunity inside to create more of a fan experience than the outside game. And so, as a fan myself of football, college football, arena football, and football in general, I'm interested to see where they go with it. I think there's a long way for them to go. Okay. So one of the big things also is selection of markets. And I think this is kind of goes into what the last question was about. My focus is underserved markets. You're not going to see us. You won't see us trying to compete in New York, Chicago, LA, some of those markets. I think, politically speaking, they're not great markets for us, but also barriers to entry, they're not great markets for us. I think that's also something that gets greatly overlooked and probably one of the downfalls of the original league. I think that there's a lot of great, what I call secondary markets across the U.S., in Canada, and then our goal is to go outside North America and develop globally. And so I look at underserved markets here. I look at who has had the product recently, and then I have to weigh some of their failures. If they had the product there, what were the failures? What were the reasons? I also look at arena capabilities. Arena capabilities to me are probably the most important. What's the top end capabilities for us to produce revenue through multiple revenue streams that I focus on? What does that look like in those markets? And I primarily like to see the 7,000 to 12,000 seat arenas. We will be in probably 4 or 5 markets in year one where they are 13,000 to 17,000 seat arenas. But typically my sweet spot is right around that 10,000 seat arena. And there's a myriad of reasons. Typically they have a lot lower overhead. You're going to see probably you're not going to see as much competition in the marketplace in those areas, and typically they're going to be closer to some of the major markets and allow you to pull when you get into those media rights deals, allow that to build and allow that to be part of the media rights what they're buying into. So also rivalries, I think, are a big thing. In a lot of ways, I look at arena football as a step up from it very similar to what goes on in college football. I think there's a lot more passion and really rivalries in college sports, and I look at arena football very similar to that. So there's some things that I think that we weigh that we've seen in the past that they haven't weighed and didn't have the data points to look at in the past, which probably created a lot of obstacles for them. Our focus is simple. I keep going back to this, but our focus out of the gates is ticket sales, ticket sales, ticket sales, season ticket sales. Get your season ticket base up. We're not relying heavily on single game. Our experience and our expertise is in promoting the product and building those season ticket numbers. When you do that, and you do that effectively, your sponsors will be there. When you do that, your merchandise will be there. However, you have to get the game presentation right. When you pull together this puzzle and you focus on each one of the individual markets as an individual market, and you focus on that immediate focus of ticket sales, and then you multiply that by 12, that in a very short term makes you a very demanded asset for streaming and media deals. There is a real step up here, and it can happen quickly, but you have to stay focused and understand you have to have the experience to be able to be successful at ticket sales and promoting it. And I think we're well ahead of where everybody else is in that lane. When you do that, when you get those media deals, you're building strong yearly returns, you're growing your valuation both in the league and in the team, which allows that step up and start selling off teams, allows exit potential from an investor standpoint, and allows that X multiple. So in the short term, the media deals help with strong yearly returns, and then your valuation growth is the franchise sales and the expansion fee sales. That really contributes to your valuation and your growth. Our timeline is simple. We're kicking off with 12 teams in U.S. and Canada this April. Our goal, simple in year one, just average 5,000 fans per game. We'll stream the games. We already have a streaming partner. It's going to be streamed in SHI gaming app. So the games are all set to be streamed. We're going to quickly grow to 18 teams in year two. The league and all the teams will be profitable during year two. Year three, we want to grow and add a UK division, a European division. So our international expansion grows overseas in year three. That's when you start to see great distributions back to the investors, and you're basically back whole as an investor. Execute these streaming partnership deals before year four and go after those heavy numbers that I showed you. And one thing I will say is, although it looks at $200 million a year for the WNBA is a good deal now, 3 years from now, that could be doubled for them. So it just shows you what the opportunity is for us moving forward here. So when I showed you our first slide, you saw that we were starting out as a tier 3. I project us to be moving back up into tier 2 in the first 3 years. And this is what starts to generate those generational wealth returns. It's not a big ask to be in 10,000 fans a game in the first 3 years. One thing you'll notice is we've got a very unique way to drive the players' salaries by keeping our costs down, because we have a revenue share. JP, our CFO, will go on that in a minute, but there's a revenue share, so they get rewarded as we do too. It's one of the ways that really differentiates our single hybrid model, by keeping our costs down and rewarding the players as we go along and as we increase and pull these extra revenue streams in. What I'm going to do now is I'm going to have JP come in and talk. He's our CFO. He's going to outline some of the potential IRRs, what it looks like when there is an exit. And then I'm available for questions at any time. I appreciate questions. I prefer to get into more of a conversation, answer what questions you have. Go ahead, JP.
Hey, y'all. I'm Jean-Paul Recht. Feel free to call me JP. just very quick background. I'm a partner of a family office that's invested in over 150 companies. Tom reached out to me, and essentially what I do is I take Tom's vision and I try to transfer it into numbers and try and make sense, make sure the model pans out. And the reason I came on and was so excited was because, I mean, I work with tech companies that aren't able to return the investors' money in the same way that this model does. I know Tom has talked about the single entity model and why that's exciting from an operations standpoint, but it's also exciting from a financial standpoint. And so, sort of walking through with you why that is, what you can expect to see, why the model makes sense, and why it's still, I mean, these are big numbers, but why is that still conservative? So, starting off, just taking a look at if there are three tiers of investment, 100,000, which is the minimum, 500,000, 1 million, and seeing how that grows, what you can expect from cash distributions prior to exit, and what you can expect to see when exits do occur. So, starting with 10 million shares, investment of 100,000 gets you 20,000. So, first we'll talk about distributions. And so, as Tom explained in how we're establishing the league, our first step is profitability with ticket sales, sponsorships, merchandising before the media deals. We don't want to get stuck into a media deal that's going to be a trap 5, 10 years down the road. That's not going to look great for us in retrospect. And so, just doing that and signing our first media deal in 3 to 4 years, our aim is to make the investors whole just by the revenue generated by the company. That's not selling equity in the teams. That's not selling equity in the league, just through operations of the company. And uh, sort of one thing I want to highlight here is that with just a 79% IRR, when we look back at the first slide, the MLS was 1,000% over 10 years. These are very in line with what we see in the industry and what we can expect, especially given I think Tom was very bashful and humble, but didn't explain that he has done this before twice. He took the Arizona Rattlers to profitability. He took them to over 10,000 in attendance annually. And then he went over and did it again in Pennsylvania. So he's done this before. He knows how to do it. And these numbers, I would say, are quite conservative given what we predict. So distributions aim to make whole and in the first 5 years, get most of the way there in the first 3 years. After that, starting to look at original team equity sales. So we're going to sell, as Tom mentioned, 75% of the original team's equity. Looking at we've seen 4x of net income is probably what you could expect. So year three is going to be around 4 million. So 4 to 5 million. So we're estimating conservatively 20 million for those teams. So 75% of that return back to you, or actually it's 100% of that return back to you. 100% of the 75% is returned back to you. So that's 360. The expansion fees, Tom mentioned a little bit of profit sharing there. And so how that works is a certain percentage goes to the league, a certain percentage goes to the team, and then a certain percentage goes to the players. And Tom mentioned that part of what differentiates the tiers of teams isn't just the attendance, but also how much is paying the players. How much can I, as a kid, fantasize about, creating general wealth through my prospects and playing in the NFL and the MLB, in the IAL. And so that's part of why we want to do this profit sharing. They create the entertainment product, they create the experience. They should receive some of the proceeds from creating such a good entertainment. So from just the expansion fees, we're expecting about 160,000 on 100,000 investment, not just selling off 4 teams after the first 3 years. Obviously, we expect to go internationally, and so that can only go up and up. And so the non-cash value is that this isn't even selling your stake in the league and what remains in the 25% of the teams, what remains in the expansion teams, the rights to the future profits. We expect even that to go up 3x in the first 3 years. So even though you're seeing a 575,000 return on 100,000 initial investment, that doesn't include your right to sell should there an exit occur in the future if they were to be bought out by another team, a second tier league, something like that. So that's the point there being is that this hybrid single entity model allows you to receive distributions as a normal business would. It allows you to see exit equity and the expansion of the team as it grows. It's not just going to be used to fund operation. It's going to be to make the investor whole. You're not going to be waiting 10, 20 years to see your money back. Our goal is to get that back to you so you can turn that around and make similar investments in your own lives. So I think that's a good encompassing of the model. And so the question is, how do you get involved? If you're interested, If I can see the next slide. And so the first thing to highlight is have to be an accredited investor. As with most things in this space, pretty simple rules. You self-certify. We're not going to audit you. We're not going to do anything. You just sign a thing that says, I am an accredited investor, which means you either have $1 million in net worth, excluding your primary residence, or you make $200,000 a year as an individual, or $300,000 a year in a household. And you expect that to continue. It's not a one-off thing. And so let's assume you fit those criteria. Then you can participate in this equity fundraise. And the terms are we're raising 15 million at a 50 million valuation. And we're setting aside 25% for retail investors, which the minimum investment for that would be 100,000. We don't want to fill up the cap table too much. That exposes you to SEC risks, more filing requirements, only burdens the stakeholders. And if you want to get in contact, please, next slide, feel free to contact Tom at any of these addresses, and we're happy to walk you through. We have a model where we pull all these numbers through. Happy to walk you through anything, send you the documents, whatever y'all would need. So thank you for your time. I appreciate being able to help y'all.
Hey, JP, we got a question coming in. Let me answer this. It says, will focusing on secondary smaller markets impact your ability to sell the streaming TV rights? I imagine the smaller markets would mean less demand fan support. So less demand fan support when looking at the larger scalability. That's a two-part question. So a lot of our smaller markets are within range of the larger markets, but we're going to have a good mix, I think. And our goal is global growth. So by year five, I plan on having at least 3 divisions of 6 outside of North America. When you start looking at having divisions in the U.S. and divisions in Canada and 3 divisions outside of North America, all of a sudden, now you're looking at exuberant media rights and major coverage across the globe. So I think you have to kind of take a look at, again, we're much different in what our vision is and where we're going. I think you just saw the NFL announce that they're doing, the NFL is trying to play a full schedule overseas because they've got such a great media rights deal here. They're playing overseas to get a new media rights deal for overseas. We have the ability to grow and kind of feed off of that buzz that they create in different areas across the globe. But we have an easier path based on infrastructure needed to complete a league for us and a vision for us. It's a lot easier for us to field that than it is for them. So I don't necessarily see that hurting the media rights if we do this right, because what will happen is you're creating demand. If you get ticket sales right, if you get sponsorships right, and you get merchandise, that's demand. They want to be part of that. They're hungry for content, and there's a bidding war going on. So I don't see that as a factor.
All right, great. Thanks for that. I see another question that came in about the recording. So this is being recorded, and we will also send out that recording probably at the latest tomorrow. So anybody who has registered can see the recording at their own time. And do we have any more questions for our presenters today before we let you go? We do have their contact information up, and there was a lot of good information so far.
All right.
So don't be shy.
So why will this arena league succeed when the past ones have failed? To be asked simply. Yeah, very simple. We have operational expertise at the highest level. Let me just correct something that JP said. I was part of a team in Arizona that helped do one of the biggest turnarounds. I had a big part in it, but there was some other people that definitely had a big part in it as well. But I also did have the #1 team in indoor football, and I've been across the country numerous times building inside sales teams that were very successful. The model, we don't just have data points of success. We have data points of what everybody else is doing that's failing, and it's years. So I spent years traveling around and getting inside these leagues and trying to teach them what to do, what to stay away from, how to get returns on their marketing, and how to grow and promote the brand properly. So the model, we have to have the right team. You have to have the right model. You have to have the right team, and then you have to execute it properly, put on a great game presentation. There's no doubt that there's a demand for the product, and there's no doubt that I've got the right team. So simply put, we will succeed. And I don't look at the current landscape of teams out there as competition for us. Again, we're already kicking off with teams in Canada and the U.S. We will take advantage of there's also a huge demand overseas, not just here in the U.S. There's a demand overseas for more content and live content. And when we bring them this fast-paced action inside of people hitting each other, you're going to see a lot of arenas filled with people high-fiving each other, drinking beers, spilling beers, and footballs flying in the stands. You're going to see great music and people walking out of there telling everybody about it. So I'm not, I don't compare us to anything else that's out there. They don't have the data points that we have to build on. Yeah, so the CFL and the UFL are both outdoor leagues. I focus 100% on sports entertainment. The stuff I'm talking about gives us a major advantage. It's more intimate. You hear the players. There's energy. There's more energy in our buildings. You're talking about outside stadiums. For this question, why don't you view leagues like the CFL, UFL, et cetera, as competition? Outside stadiums, they're trying to fill 20,000, 30,000, 40,000 seat stadiums. We're putting 10,000 people in a building in a tight-knit area, and it's just a lot more energy you can pump into a building. Energy is fan experience. We can do more pyrotechnics in an enclosed area, and the games are faster. The other part about it is, I don't look at us trying to promote ourselves as a step up to the NFL. We are our own brand. We're a cross between what the Globetrotters do and what the NHL does, and then you throw a concert in there. So I just look at us as a completely different thing. Our players are the 2 and 3 percenters that you saw playing great college football. Some of them come from the CFL or the UFL. But once we elevate, and our pay raises because of this model where there's revenue sharing for the players, I think we will be the primary destination for the players that go to the CFL and UFL for money. We're raising the pay, but we're doing it on a different scale. We're giving them rewards for being part of what we're doing. And I think that is going to create demand to want to be part of our league. Is there a minimum time frame to invest your money? Well, we only have 25% set aside for the retail investors. So there is once we reach that point, we're going to close that side of things. We have a group working with us for institutional investors, helping us do the other 75% raise. So it's basically first come, first serve until we hit that 25% for the retail side. Any other questions? I like the questions.
Yeah, please ask questions while we have them.
Is my money tied up for X amount of years? So we're looking at things. JP, do you want to go into this? You want me to?
Yeah, I mean, pretty simply, we're looking to get the money back through distributions, through equity sales. We don't expect to. I mean, Tom can correct me if I'm wrong here. We don't expect to sell to a larger entity and completely exit with any certain amount of time frame, but we do expect to provide the investors their money back as quickly as possible. Like I said, through the profits generated through the business. They're selling expansion teams, through selling equity in the 75% of the original team's equity. There's plenty of mechanisms to get the money back. As for completely exiting, Tom and I leaving, selling 100% of the business like you would expect from a tech startup, I don't think that's on the table anytime soon.
Scott, let me answer it this way. Let me look 10 years down the road. 10 years down the road, in my vision, we own 40 teams across the globe, and we only own the IAL owns 25% of them. And we've sold off 75%. So we've built and sold and built and sold. Every time we build and sold and build and sell 75%, it's more money to the initial IAL investors. Your exit really is up to you because we're going to have a lock on the amount of shares available to be bought in the IAL group. So as we get those media rights deals in, as we get the build and sell deals in, your position keeps growing and growing and growing. The valuation of your position grows and grows and grows. When you want to sell that position is entirely up to you. We have distributions. We believe we're starting before year 3 My goal is to keep money invested in 1 and 2 so we can grow rapidly just in North America in the first 2 years. One of the things I didn't touch on is our all-star game in year 1. We're already planning on expanding into Europe. Our all-star game in year 1 is overseas. We're playing an all-star game in Europe in year 1, and our championship tournament is a 6-week tournament that we're hosting in Las Vegas. We are doing things that are going to create demand and drive interest. And so these are the things that is going to make you a lot of money and you a lot of money in the very near term. Your exit will be entirely up to you.
All right. Well, it looks like the questions have started to slow down. So, if anybody has any further questions, I see that their contact information is up on the screen. So please reach out to Tom and or JP with any questions. Even if you're watching the recording after the fact, please use that contact information. And I'd like to thank you, Tom and JP, one more time for all of your time and the great information you provided today. And I hope everyone has a great rest of their day.
Hey, thanks, William. Thank you, guys.
Thank you.
Thanks.